I've been looking forward to making this video for quite some time now, and for good reason, because today we're going to talk about using copulas for statistical arbitrage. And so no cointegration required. You can do pairs trading without that. You can simply look at using probability distributions to come up with whether or not there's a potential arbitrage opportunity between two assets. And I learned about this strategy actually from Hudson and Thames. Of course, full disclosure, my cousin is one of the founders of Hudson and Thames. But nonetheless, this is where I first heard the word copula, and ever since then, I've been going really deep into that and doing a lot of research. So this is a great video. I'll make sure that I link to it as well. But the goal of the video that I'm doing here is just to give you an understanding of what a copula actually is, a very strong intuition, so that any analysis or research you do after this, you understand what it is you're actually trying to accomplish, which is, funnily enough, something I really struggled with when I was first learning about these. So again, this is supposed to be the video that I wish I had had, and I really hope that it works well for you as well. So what actually is a copula? What is this funny looking, weird stingray type shape over here? And why am I saying that we can use it for arbitrage? Well, to get an intuition behind this, let's just role play for a second. Let's just say that you and I start trading at a proprietary trading firm, and they say, we need you to come up with a new strategy. And the catch is that you can only come up with a strategy that relies purely on probability and probabilistic distributions. No cointegration allowed, nothing like that. You can only come up with a strategy based on probability distributions of the assets you're trading. So we decide, okay, we're going to do a pairs trading strategy, and we decide to look at their distributions. First of all, just their normal distributions. So here I've got the prices of the S&P 500 and the NASDAQ. And by the way, I've chosen those assets for this video because they have such a strong dependency and they work really, really nicely for the illustrations. But of course, I'm running this right now for hundreds of crypto pairs. Regardless, here I've got the S&P and the NASDAQ ETF prices. And over here, I've got their returns. I'm using log returns, but you can use standard returns. It's fine. And I've calculated those returns mean and standard deviation for both X and Y, X being the S&P and Y being the Q's NASDAQ. And then all I've done here is plotted those returns. So I can move this to one side. You can see I've got the formulas here. You'll have this workbook. You can go and check those formulas out. But it's just a way to sort of scale this between -7% returns on any given day to +7%. This is daily data I'm working with after all. So if we analyze this, we can see here that the S&P is this blue line. It's thinner and taller than this pink line here, which are the Qs. So the S&P here is not quite as fat, right? The Qs are fatter. We can see that because their variance is greater. You can see that over here as well. The variance for Y is bigger than the variance for X. But X is, of course, also a bit taller because of that as well. So our mu is the center. They're both centered roughly around the same place. This sort of middle line that I'm not drawing very well down the center of these two. So on or around 0, just above 0 actually, is where their returns are centered. So you and I sit down and we scratch our heads and we say, okay, well, given that we want to make a profit by arbitraging two assets, let's actually plot them in 3D together. So we come up with something like this. This is a bivariate. I can also call it a multivariate, but because there's just two assets, I'll call it a bivariate. This is a bivariate joint normal distribution for X and Y, in this case, NASDAQ and the Qs. And so what we can see here is that, let's say the S&P is sort of hovering around returns of 0 and NASDAQ is hovering around returns of 0. I can tell you what the probability or the joint probability of that happening is. All I need to do is follow the lines up this curve over here, and I can see that the probability is somewhere up here. It's a fairly high probability density based on the joint bivariate distribution. And so this assumes, number one, that these two assets follow a normal distribution, which we know that they don't. But regardless for now, bear with me. So here we can see there's our X, there's our marginal variable there, X, which is the S&P. Here's Y, which are the Qs. Here's the mu for Y, the mu for X, the standard deviation for each, and so on and so forth. But we also have this extra term over here, which is rho. And rho represents the correlation, which is a dependence metric for those two assets. Now, this is where things start to get interesting. This dependence metric over here, this correlation, we can think of as a way to describe how these two assets relate to one another. What is the dependence between them both? And so this thinking overall points to something known as Sklar's theorem. Sklar's theorem is quite interesting because what it states is if you have a multivariate distribution that can be made up of any marginal distributions, right? So X could say follow a student T distribution, Y could follow whatever other distribution, or maybe they each have their own empirical, actual, matter-of-fact distributions that we can construct with historical data. Don't worry if you're not quite sure what an empirical distribution is right now. I haven't really covered that in the series. But you have these cumulative density functions, these probability distributions that these two assets follow. If I have that, and I can construct a multivariate distribution with the two, then there must be some function joining them together. What I'm saying is, we can take X and Y, they can have any distributions you like. And as long as we can scale them on a uniform distribution between 0 and 1, in other words, they both scaled the same, so we need to scale them the same, we can construct some kind of multivariate distribution from the two using some kind of function that joins those two distributions together. So step one is, get your returns or whatever it is you want to model, returns or prices. We're going to talk about both in this video. Get your returns or your prices, whatever you want to model. And then convert the scaling of those between 0 and 1 using a cumulative distribution function. So this is again using probability functions. When you've done that, you essentially have squeezed these two assets, which were in totally different scales and distributions, both into uniform distributions between 0 and 1. What we care about is that we have some function that models the dependency of those two assets. We have here a probability distribution showing their density for their returns. We can also come up with something that looks like this, a probability distribution showing how their dependency changes based on how the value of the returns of X and Y go up or down respectively. So for example, here, based on this copula that I'm looking at right now, the Gaussian copula, this is saying that X and Y typically, their dependency strengthens when prices are going up. It also strengthens when prices are going down. So their dependency becomes stronger. When prices are just kind of hovering around that 0 sort of % returns mark, the dependency is still there. It's actually still fairly strong, but it's not nearly as high as up here and up here. So this is what this copula is telling me. Let's look at that from a different angle. We can see that if X is really high, we're not seeing Y being very low. The dependency, we're not seeing down here. I'm not seeing a spike down here. I'm not seeing a spike over there. This is very flat over here and over there. I'm seeing the spike happening here and happening here. So this is showing me, based on the behavior of the two assets, how the dependency changes. You can imagine that this is very useful when it comes to risk analysis. You might have some kind of portfolio being managed with hundreds of thousands or millions of dollars, and the risk changes depending on how these assets move. If all of a sudden things start moving towards the downside, the correlation between two assets might be increasing dramatically, and actually the correlation increasing for those two assets means your portfolio might be less diversified. So for risk management, copulas are extremely, extremely useful, actually. We're actually going to construct this on a 2D plot together right now so that you can get a better idea of what I just said. But before I do that, let's just have a look at what sort of copulas are out there, because this is a Gaussian copula. And just like I could have picked any distribution to fit to X and Y, whether it's empirical, student T distribution, whatever distribution it is that I might come up with, I can do the same thing with copulas. It might not be a Gaussian copula that best describes the dependency between these assets. And of course, the Gaussian copula has its own parameters. So when I fit that, and you'll see, because I'm going to change this live for you as well here using this workbook, you'll see that the shape of this changes, but it still might be overall the wrong shape, just like the normal distribution for fitting the returns for the S&P and the Qs over here is actually the wrong distribution to pick. It doesn't really fit the way the returns really work. So there's different copulas that you might come across. And those copulas look something like this. These are just the standard ones out there. We've got our Gaussian copula, which is the one we just looked at. You can see you've got your dependency that increases as prices go up and down. We've got the Frank copula, which is very similar, but it's just sort of the way the distribution looks. It's not this elliptical distribution anymore. It's sort of more this squared off distribution. There you have the Clayton copula, which says that really there's not much dependency as prices move up at all. The dependency strengthens a lot on the downside, and a Gumbel copula, which is pretty much the exact opposite. So let's say you fitted all of these to your data. If the Clayton copula comes up with the best log likelihood, so we use maximum likelihood estimation here. We covered that earlier in the series. Sorry about that heavy video if you haven't seen it, but do go check it out if you're not sure what that is. If you go and fit these copulas and you come up with a better metric for the Clayton copula, then what that tells you is that the dependency for these two assets that you're analyzing really lends towards moving strongly together on the downside and not so much on the upside. That's what that in and of itself would tell you, let alone the shape of the Clayton copula, which can become more flat or more steep depending on how strong the dependency is for those assets. So really what we're talking about is fitting the copula as best as we can for each of these and seeing which one comes up with the best score. For this video, I'm just using the Gaussian copula because it's important to understand what a copula is, and I'm trying to keep things really simple. But it's a very important point to point out that knowing that there actually are a vast array of copulas out there is quite useful, because just knowing what copula best fits your data tells you about how those two assets behave and how their dependence with one another behaves. Now let's take a step back. Let's actually just forget about copulas for a moment. Let's come at this from another angle. I just want to plot the returns for the S&P and the Qs up here. Just a scatter graph that looks like this. So if I just literally scatter graph the returns that I've got here, I get something like this over here. But let's say I want to see this on a scale of 0 to 1 on the x-axis and 0 to 1 on the y-axis, rather than these fitting on their own individual axes without having any change whatsoever. How would I go about doing that? Well, as mentioned earlier, we can fit these to a uniform distribution. And how do we do that? Well, we use a cumulative density function, also known as a probability distribution. And so that looks something like this. You have your x-axis on the bottom, you have your y-axis, which is the probability between 0 and 1 of x taking on any kind of value. So if x is up here, it might take on a probability of, let's say, I don't know, 98%. And if x is somewhere in the middle, so its returns are, I don't know, something like 0.025%, whatever it is, the probability of that happening for x, which in this case is the S&P, might be something like 50%. So I can actually take the values once I've fitted x to some kind of distribution, whether it's empirical, a normal distribution, a student t distribution, whatever it is. I can take those x values and then create values between 0 and 1 for all of those values. And now I have a data set full of values between 0 and 1 that actually represents the distribution of x. And I can do the same thing for y as well. And I can use whichever distributions best fit that asset. Again, whether it's their empirical distributions or some other distributions. They can have different distributions. This is one of the nice things about copulas, is I can model the dependency between assets that don't even follow the same distribution. The important thing to note here is once I get these uniform marginal distributions for x and y, which I'm now calling U1 and U2, U1 for x, U2 for y, I can now employ this idea of Sklar's theorem, which states that to get to a multivariate distribution, or in our case, a bivariate distribution, there will be some copula that joins those things together. And I can use some of the copulas that have been derived out there for us already that we've spoken about here. And in fact, today, we're actually using the Gaussian copula. Now, when I go and plot U1 and U2 on a scatter plot, I get something that looks like this. So we've gone from this sort of looking plot over to this looking plot with this essentially the same data. We've just transformed it using that cumulative distribution function to get values between 0 and 1. And this is where things really start to get interesting, because it's these outliers outside of this sort of green line that I'm drawing here. It's these outliers that we care about. This one here, this one up here, this one here, this one here. These represent the trading opportunities. How do I know what barriers to use? Well, we're going to talk about that shortly. know that these represent my trading opportunities, because this is saying, for example, let's say we're not looking at returns. Let's say here we're looking at price. In fact, I have one of these based on price and not return. So let me jump to that. Here's one based on price. I could actually draw the same thing up here as well. I could draw, say, 2 green lines like that and just say that, hey, anything out here, these sort of outliers, these here are what I'm interested in based on some kind of confidence level. If I made my confidence level a bit more strict, then it would really be, say, this 1 or 2 or 3 or 4 occasions where, these sort of just met the fringes here. These are my trading opportunities. Why do I say that? Because what I can do once I have this, once I have these copulas, I can calculate what's known as the conditional probability. So in other words, what is the probability of the S&P being where it is given where the NASDAQ is right now? Or to write that more concretely here, what is the probability of U1, meaning the SPY, being less than or equal to where it is right now, so little U1, given that U2 is equal to where it is right now? In other words, what is the probability of the S&P being less than or equal to where it is right now, given that the NASDAQ's price right now is, this current value over here? And let's say that probability there is less than or equal to 5%. And this is now really following that Hudson and Thames video's logic, and there's obviously papers linked to that as well. So we'll come back to that in a moment. But this is really what it's saying. I could also look at it from the other way. I could say, what is the probability that U2, in other words, the Qs, are less than and equal to whatever value they are now at, given that U1 is the price that it's at right now. And let's say that that is greater than or equal to 95%. So when I look at that, what that would be saying is that U1 is definitely undervalued in respect to U2, and U2 is definitely overvalued in respect to U1. So what I would do here is go long on U1 and short on U2. In other words, here I'm going long on the spread. That means going long on U1 and short on U2. So let's say that X here is at 0.7. If I follow that up here, you can see that it's very unlikely. In fact, we've never seen Y being down here. I should say U1 and U2. U2 has never been down here, right? It's always been up here. That's where it lives when X is at 0.7. We would expect to see the price for U2 up here because we're looking at a scatter plot of 0.7 in the past and where Y has ended up. We've never, for example, seen X being at 0.2 and Y being at 0.8. That's never happened in the history of this data set that I'm looking at here. It's never, ever happened. So the way I could write this is I could say the probability of, and here I'm just going to say the S&P, which is the same thing as saying U1, is less than or equal to 0.7, like such. So where it's at right now, so we've said it's at this 0.7 mark, given that the Qs over here, I'm just going to write Qs like this, are equal to 0.9. So let's say that here's our data point up here. So if I follow 0.9 all the way along and 0.7 all the way along, X marks the spot. That's where we've got to over here. Here's our data point. The probability of that happening is going to be super low. Very unlikely that the S&P is going to be less than or equal to 0.7 when the Qs are so high. We would expect X to be a much higher number in line with the Qs. So if X is at 0.7, then the probability of that given where the Qs are is, let's say that's 0.001%, like a really small percentage likelihood that that's going to happen. Same thing here, I could say the probability that the Qs, so again, I'm just going to write Qs like that, are less than or equal to 0.9, given that the SPY is equal to 0.7. So when I look at it like this, then I'm saying the Qs are less than or equal to 0.9. So what is the probability of them being down here less than the 0.9, given that the Qs are at 0.7? well, the probability is pretty much 100% because that's always what's happened using this historical data. So let's just say that's like, 99.9% likely over here. Then what that would signal to me is that there's a trading opportunity here to go short on the Qs and long on the SPY over here. So here we would actually short the Qs, yep, and go long on the SPY because the SPY is undervalued in respect to the Qs. And if it was the opposite, if it was like, say, down here, it was the other way around, we would do the reverse. And so that's really what we're trying to do, is to figure out what is this conditional probability based on using a copula, so that we can use that to see mathematically what is the likelihood that the conditional probability, I should say, that we are where we are given the price of the other asset. And if that's not in balance, that there is our arbitrage opportunity, and that there is really what the Hudson and Thames video is talking about here. Here we are talking about prices, both in the Hudson and Thames video and over here. I'm talking about prices. I'm no longer using these returns, but it does often make sense to use returns. And this video will also tell you how to go about using returns in a trading strategy. I want to make this video less about the trading strategy actually, and more about what copulas actually are. But I know obviously you're going to be interested in the trading strategy part of that. If you're interested in copulas, I'm sure you will be. And for sure, if you're interested in pairs trading and copulas, I know for sure you will be. This is definitely the video to check out because it'll talk about how to use the returns. But nonetheless, just try to understand the spirit of what we're trying to do. We are putting together a copula function, which we haven't even looked at yet, but we're putting together a copula function that also has a formula in it that will give us these conditional probabilities. And of course, this workbook will be made available to you as well. And here's what that workbook actually looks like. I've actually gone ahead and put this together. So here I've got my U1 and U2. Here's a bunch of formulas that follow the math formulas on the right that we'll look at shortly. And here's my derived copula. These H functions are my conditional likelihoods. And in fact, I can fix the likelihood to a 5% and a 95% confidence level. And when doing that, that will construct these green bands. And so what we're saying is that if the prices, or in this case, I'm actually looking at returns, if they fall outside of these green bands, then I have a trading opportunity of some kind. Let's just take a look here at these math functions as well. Here I've got my joint copula density function. This is for a Gaussian copula. There are many different types of copulas as we've looked at. This is just for a normal copula, assuming a normal copula best fits your data, which it might not. But this is what these formulas look like. There's the joint copula density function. Here's the copula distribution function. And importantly, here is the conditional copula distribution. So U1 being less than or equal to what it is given U2. That's given here by this formula here. And of course, this has all been modeled in Excel for you so you can play around and try to get an understanding of what's going on. What I want to do, what I want to focus on here with this slide and this page for you in particular is this density here, to try to get used to what this density is showing you. Because, you know, funny enough, and again, I should just add a little tail here. I think I'm missing a row down here or something. This over here, you can see very much does resemble the scatter plot. We can see that the density does increase at both upper and lower ends or tails of this scatter plot distribution. We can see that in fact does happen. And we can see in fact it is wider over here, over these areas there. And that's exactly what we see here. The density is a bit more relaxed down here in the middle, and it's a bit more stringent on the upper and lower right tails. And of course, there's a positive dependency here. So these are positively correlated. And through building this copula, you actually do fortunately get a derived correlation number. And this is great because actually this correlation number is dependent upon fitting of this copula. This is not so much just the Pearson correlation coefficient, although it actually might be, because here we're using elliptical Gaussian copulas. I need to think about that for a moment. So it actually might be, but you can basically compute true correlation for financial assets using copulas. What's interesting here is, let's say that this 0.93, which I fitted using maximum likelihood estimation. If you haven't seen that, go and check the earlier video again in the series. But let's say down here, it's actually 0.2. Well, now you see that these bands are a lot more relaxed. And really, this Copula, the values would have to be far out here for me to consider potentially trading. And this here looks far more like a stingray. We could even put this negative. We could say it's negative, I don't know, 0.5. And you can see then this whole thing inverts there. And again, it's more relaxed because I've made the dependency not as high as 93%. It's now at 50% on the negative side. So you can see here how this Copula, how the probability distribution of the dependency between these two assets changes. And this is just for the Gaussian Copula. In fact, here it is based on price. So I've got a tab here modeling the prices, not the returns. And you can see, of course, the correlation for that is a lot higher, again, because I'm working with prices here. But you have this really sharp now looking Gaussian dependency, this distribution here. So if a price was to fall out here, or for example, out here somewhere in the data, that would present a trading opportunity. And so that's all this page here is actually doing, is just showing this to you, but for the prices rather than the returns. This guy here, Paul Sweeting, thank you so much if you ever see this video, because your series on this was absolutely fantastic. I know I left a lot of comments on your videos, but I've got to tell you that this was absolutely fantastic for me. Thank you so much. I had very expensive books here on copulas. I got all of the different books I could find on copulas because I was really trying to understand them. But your videos really helped for things to click in place. And for you, of course, watching this as well, definitely check out Paul's channel and his playlist on copulas. He's coming at it more from a risk management perspective, but nonetheless, he goes into the math and the detail of copulas very well. To summarize, what we've done here is spoken about how we can use this dependency probability distribution to join together our two assets, going right back to here, our SPY and our Qs, both for the returns or the prices. And your strategy on how you arbitrage those differs. It's very straightforward for prices because we just assume price is low, short one, long the other. For returns, it's a bit more complex. Again, you can refer to the other video on that from Hudson and Thames. But regardless, what we've done is spoken about how we can take these two distributions, squeeze them on a scale between 0 and 1, and use some kind of dependency function to join them together. And in doing so, we actually get a conditional probability calculation out of doing that. And when we have that conditional probability calculation, we can spot outliers in the data. Now, I've backtested this, by the way, for over 1,400 different pairs already in crypto, using a much more advanced backtesting algorithm that's coming to the platform very soon. And it's a much more conservative algorithm too. The best trade it found was 458% return. The worst is losing 100%, but that's expected. You're going to have some which go horribly wrong and some which go terribly right. So the key thing was to look at, on average, how did it perform? And on average, it returned 8%. This is including looking at all the break-evens, all the losses, all the gains. And 60% of the time it was profitable and 40% of the time it wasn't. And that was using a 10% and a 90% confidence threshold. So that was looking at these green bars relaxing a bit. When I made those a bit tougher, when I made it a bit more stringent, going to this 5% and 95% level, I found fewer profitable opportunities, funnily enough. However, overall, the strategy was more profitable. The average return was actually higher. The best return wasn't 458%, but the Sharpe ratio or the average Sharpe ratio and also the average returns was better overall. So this has, of course, been a very, very interesting subject for me to research. I'm running machine learning algorithms, trying to find the best combinations between all sorts of metrics, between cointegration, copulas, everything, for predicting winning strategies with a high success rate. And so far, that algorithm is looking ridiculously good. So much so that I don't even want to talk about it right now in case, and probably I've got something wrong. It's too good to be true. It usually is. But I do want to say that this is definitely a very strong tool to add to your arsenal, particularly in trading crypto. And I'm really looking forward to bringing it to the platform soon as well. The engine's actually built. It's now just about connecting it to all the front end pieces. So again, check Paul's channel out. Check this video out too. I do want to thank you as well for following along in this series. I know it's been heavy. I know it's been a heck of a lot. But I also believe strongly that once you see the stuff, you can't unsee it. And it's very good because it's very objective. You know, there are empirical papers written on trading copulas and profitable strategies. And, you know, they argue between, is it as profitable as it used to be? And then there are Vine copulas, which are now bringing out really profitable looking strategies in the stock market, of which I've seen no analysis in crypto for. There's so much to dig into here that you can't ignore this, because empirically, this is the stuff that's being looked at for statistical arbitrage. And it's the stuff that gets used in a lot of hedge funds and institutions. And hopefully now it's more understandable as to these tools and techniques some of these big players are using, so that everyday folk like you and me can follow along. So thank you for following this series. I hope you found it useful. This workbook will be in the description as well. Until the next one, take care and talk soon.